It's not just about saving tax. What you do before June 30th could shape your entire investment strategy for the next financial year. From missing deductions to super traps and new ATO rules, the risks and opportunities are bigger than most doctors realize.
Every $100 that you are spending, you're only going to get $47 back. Do you need that $100 to be spent in the first place?
In this episode of the Investing for Doctors podcast, I'm joined by Munzurul Khan to break down exactly what high-income professionals should be doing right now to avoid common tax mistakes and unlock smarter strategies across super, property, trusts, and other investments. In this episode, we cover what you can and should prepay before June 30th to boost deductions, the hidden traps in claiming interest and investment expenses, when to use carry-forward super contributions, and when to hold on to cash, and why most doctors are overpaying tax simply because they didn't plan early enough.
Make sure you do have end of financial year tax planning with your accountant. You'd be surprised to see how many people still don't actually have it. Have a financial planning meeting. Don't do it too late towards end of June. Do it early June, so you've got enough time to implement everything.
If you haven't had a tax planning session yet, this episode is your warning and your cheat sheet. Now let's get into it. Hello everyone. Welcome to another installment of the Investing for Doctors podcast. I'm your host, Dr. B. And today we have Mr. Munzurul Khan from KHI Partners with us again.
Thank you. Thank you. Thank you. Look forward to it. Thank you.
Yeah. And so as everyone knows, Munzurul is an accountant extraordinaire, and he's got lots and lots of experience also as a property investor. And so this episode will be focusing on the end of financial year.
Right.
We're getting towards the end of financial year again, and it's the same questions. Right. What do I need to get done before June 30th? Right. And so let's explore a couple of tax planning strategies or things that you should do before we take over into the new financial year.
Absolutely. Thank you, B. Thank you for having myself. I suppose, B, when the tax planning sort of comes in, the first question we sort of ask is that tax planning for whom? Is it for individual? Is it for mom and dad? Is it for a investment trust or a proprietary limited with investments? Is it a business entity as such? Is it a superannuation fund, right? And on the basis of all of the above is that your tax planning varies, right?
You have a holistic advice, and you're very good at making everything very complicated. So we'll keep it simple. We'll keep it simple initially. We're going to be talking about personal, individual.
Excellent, love it.
What are the deductions, or what are the little things you need to do to get before June 30th?
Love it. Love it. Absolutely. Now, the individual tax returns is always on a cash basis.
Yes.
Yeah? So cash basis means is that what you have disbursed, what you have paid, is that if it is tax deductible, then we can claim it. And tax deductibility effectively means is that any expenses which you incurred in relation to your income generating activities, as long as it's not personal, capital, and all the rest of it, then it's tax deductible, right? So what are the things that an individual can plan? Individual, we sort of break it down saying that it would be salaries and wages and the tax deductibility behind it. Then we say the investments that the individual will have and the deductibility behind it. Yeah. So individual as a salaries and wages as a doctor, right? You do a whole lot of subscription, you do your indemnity insurance, and you may buy lots of books, and you may have done a course, and these are all in relation to your income generating. All of those would be deductible. You might have gone in different level of conferences, right? And as part of going into different level of conferences
Or what about planning to go?
The actual expenses, as long as you sort of paid that invoice and the actual conference is in July, but you paid it before June, that's fine because
you
it
can
is
prepay.
Necessity. You can definitely prepay.
Because it's cash basis.
Absolutely. Cash basis, you can definitely, right? And it's sort of quite that, yes, I'm definitely going in July, and it isn't. And to be technical, all that basically means, whatever reason, if you don't go there next year, then you just need to bring that back into your next year's return as an income. So it sort of balances out, right? So interest is, that is definitely deductible, right? Your travel expenses, your conferences, you know what? You went there in this conferences and you had to stay a couple of nights. Conference was a couple of nights. Your predominant purpose in terms of your travel was the conference, means that it would still be deductible. So all of those are standard, your sort of deductibility, your last year's tax agents pay, and any other expenses that you incurred. So you drive around, you've got your car, going from home to your primary place is non-deductible. But from home, you travel into a whole bunch of different places. then arguably a good portion of it would be deductible.
Yep.
You might need to keep a logbook. You might need to have some substantiation. And if it's not under a 5,000 kilometer basis, your accountant should still be able to claim. So my recommendation is that from an individual side of it is that all the expenses which you incur, whether you're sure or whether you're slightly unsure, still keep a substantiation behind it.
Yep.
Pass it away to your accountant saying that these are all the expenses that I incurred. Can I claim all of those? I bought this laptop, I bought this, and I bought this equipment as such. Your accountant will say, yes, these are all being necessary. Or accountant may say that, well, we'll capitalize some of those and we'll depreciate over a period of time. Or either it could be personal. Yeah. An expense sometimes we miss is income protection insurance.
Yes.
Yeah. Sometimes we sort of say that, well, the income protection insurance, did we pay it individually? Did we pay it, through a super? It's more common of paying individually, right? But in super can be. If you paid the income protection insurance from your personal name, you can definitely claim that on your individual name as well, right? So that's where the deductibility comes in. Life insurance TPDs are not deductible from a tax side of it. So all those different expenses from an individual. Then we look back and say that, well, how about from an investment point of view? And the investment point of view, we break it down saying that the property investments as well as shares, managed funds, crypto, business investments,
everything.
right? Any expenses which you incur in relation to the investments are also deductible. Any pre-expense that you incur, they're not deductible, right? Because they're pre as such. They become a bit more capital cost. Investment property, as an example, you've got those standard sort of the cost. Your council rate, your water rate, your insurances, your repairs and maintenance, your cleaning, all of those expenses that you can claim it. Where at times we miss away some of the things is that when we buy a new property, as an example, as part of the solicitor settlement adjustment, there is a whole bunch of expenses on the solicitor settlement expenses that it gets adjusted. Let's say that one of my property getting settled today, I purchased today, and let's say I'm buying it from yourself. You've already paid the council rate for the full year, and I got to reimburse you as part of the settlement from now until 30th of June.
Yes.
And because I'm reimbursing this amount to you, is that this is a tax deductible in my hand. Now, where we miss away this at times is that we are actually not physically paying it. This all gets adjusted as part of that final
part
figure
of the settlement,
that we pay.
there's all the little...
So not to miss that away, right?
Yeah.
The other thing what at times we miss away is that the LMI, the lender's mortgage insurance. As a doctor, you can go up to 90%, you can go up to 95%, but it may have been bought on a trust in different structure. It could be on the husband and the wife's name, or maybe you paid for whatever is an LMI. If you pay the LMI, lender's mortgage insurance, that is claimable over 5 years or the term of the contract, whatever is lesser. Generally 5 years, right? Similarly, is that there could be an application fee. The strata fee and the strata report can be claimed over 5 years. Your building report and the pest report can be claimed over 5 years as well. So all of those deduction can be claimed.
Can I ask, why 5 years?
Good question. The ATO's rule, right? ATO
They just
sort of
made
say,
up a number.
that's right.
Okay.
It's a
That's fine. If that's the best rationale for it. I mean, the pest doesn't really change.
No, they call them as borrowing costs, right? It means that the cost that you incur in relation to the borrowing of the funding and those costs that we claim that over 5 years or the term of the contract, whatever is lesser, right? Where one got to be careful is that the interest deductibility. This is where ATO gets most sensitive because this is by far the biggest cost. And the interest deductibility means, let's say you bought a particular property for $1 million and you borrowed 800,000 and the other 200,000 you generally paid cash. So you only can claim 800,000. But if you utilize the other 200,000 plus the incidental cost, which is another 5%, 250 from, let's say, as a security from a different property, then if it's being done in the right way, you can claim the interest on the original 800,000 of $1 million. And from the other property that you've taken 250,000, you can also claim the interest as well, right? But it needs to have the substantiation in the right way. The other side of that is that, let's say this property now from 1 million, it's gone up to 2 million. And what you've done is that you've drawn down an extra 400,000 for you to sort of do something else. That 400,000 is not going to be deductible on your individual name. It may still be deductible on the basis of the purpose of as it is, where it is being utilized. It can still be deductible in there. but not on your individual. So I suppose what are the tax planning comes in? Tax planning comes in is to ensure that all the deductibility that you are allowed to, that you are claiming it, whether you can prepay your interest, whether you can prepay your insurances, claimable. Yeah.
So that is claimable, right? If I say I'm going to prepay the interest for the next 6 months.
Up to 12 months, right?
Up to 12
That's
months,
right. That's right. 6 months you can, absolutely. You can pay 2 months, you can pay, 9 months, 12 months. So up to 12 months, it's claimable. Where the strategy comes in with this is that very often we say it's a timing difference, right? Means that, okay, I paid that advance next year, means next year there's no more deduction unless I pay advance again. So if I keep paying the advance, there got to be a year of catch up.
Yeah.
But if you plan it in the right way, it may still be quite effective.
Say if I'm going on a paternity leave.
Exactly.
Yeah.
Exactly, right? Paternity leave, and you're going away in overseas and you've taken a year off from
sabbatical.
work, sabbatical, and then you've gone back into part-time role, right? And your income sort of dropped. So you may actually actively plan and say that, yes, I'm going to roll over for a period of time. And this is the year that I get that benefit in terms of that deduction side of it, right? So the last comment, which I say in terms of the individual side of it, of the deductibility, is that sometimes people come in and say, oh, Munzurul, can I invest? Can I spend that bit of the money? And it's tax deductible, so it's a good thing. Let me rush into it. And shall I do it before 30th of June? I sort of say that, remembering that every $100 that you are spending, what you get is a $100 deduction. But what you actually get as a tax benefit in your hand is on the basis of your marginal rate.
Marginal rate, yeah.
And even if your marginal rate is the highest, and 45% plus 2% is Medicare 47, means that you're only going to get $47 back. And there is that $53 is that arguably you are not getting it. So what I say to my client, I say that if you need to spend that $100, rather than spending it because of tax, do you need that $100 to be spent in the first place? Because one may argue that if you do not need to spend it, save the $53.
Save the $53, yeah.
As opposed
I think
to
a lot of doctors
47.
get caught up on that. And it's like, oh, if I did this, it's a tax saving. I was like, but do you really need it?
Do you need it? Exactly is the point, right? And the other thing is that the super, right? I mean, we use as quite a bit of a strategy, right?
Yes.
And we sort of say, well, okay, we've got our employer contribution, SGC, superannuation guarantee charges, 11.5% and so, right? And then we sort of say, well, what's our maximum contribution? It used to be about 27.5, now gone up to 30. So 30 is the maximum. So what you can do is that as a planning mechanism is close to the year end is to say that, well, where am I sitting? And if there is a $5,000, $7,000, $10,000 gap in between your minimum contribution as opposed to that 30 odd grand, then you can make that contribution. Yeah. And by doing it this way, it becomes deductible. Sometimes doctors sort of come in and say, well, can I use a carry back provision of the prior year of the unused amount?
You have that 5 years of worth of that.
Yeah. Where the trick comes in though, is that as long as your super fund balance, members balance is less than 500,000.
Less than $500,000, yeah.
Yeah. Say if it is over $500,000, then there is no carry back.
And use it up before it hits $500,000.
You would, right? You would. Yeah. So if there is a carry back provision and if your cash flow allows it, absolutely consider this. Yeah, absolutely.
And what I realized is that even if your guarantee contribution goes above the $30 million cap, it actually backfills the carry forward.
It does.
Yeah,
it does. It automatically goes back, checks it,
that's good.
Whether it is, and only then it sort of pays extra tax.
Yeah. So if you're a early career consultant and you're now earning more than what you used to, and you're getting more than $30,000 worth of super contributed by your employer, don't worry too much about it because that's backfilling all the other
stuff.
That's right.
And then, everything we take it with a sense of longer term view and a sense of pragmatism, in the sense that I've got younger doctors at times, they sort of say, all right, can I keep putting money into the super up to 30 odd grand, right? And do the maximum contribution. I get, can I do salary sacrifice? Can I do it this way? And I get the tax benefit. And I sort of say that you're right. You do get the tax benefit. And this is by no means financial planning, but this is a question that I raise and for one to ponder. And the question that I raise is that how much cash do you need in your hand at this stage, right? Because if you sort of early 20s, mid 20s, early 30s, is that what is your priority, right? Is your priority to keep building the super, or is your priority is to say, well, I want to keep as much cash as in my hand Number one is the mitigation. Number two are the future expenses of kids and all the rest, right?
Yeah.
But equally important, if not more, is to pay off your principal place of residence. Because if you've got a loan against a principal place of residence and you're paying 6% interest, then I do the maths in reverse and I sort of say, well, I've got to be earning about 11, 12%, pay the tax to get that net 6% to pay it. Right, so you're actually giving them 11, 12% return in there, right?
Well, it depends on how much tax you're saving as well, right? So
that's right.
It's all a cash flow at the end of the day.
Yeah.
And I think you got a very, very good point. It's like when I was younger in my earlier days, I didn't quite believe in contributing excessively into super because I needed the cash. I needed the money outside of super to fund my lifestyle or to buy properties or to do other things. But as I get older and older now, I'm like, oh yeah, I'll contribute to my super.
That's 100% agree, right? And there's a number of reasons why we agree. One is that because of that cash flow. Number two, we're close to the retirement. And number three is that super always has that sense of uncertainty that what is the government going to do with the changes, right? The legislative risk. And it generally has, because super is very, very discounted taxed, still is, right? And when it's being very discounted tax, then you sort of say, we don't know what the tax would be in the future, right?
And exactly this point, we've seen successive iterations of government having new policies that affect super in a both positive and negative way, you know, in terms of release during COVID, in terms of now you have the first home super saver scheme, whatever that's called, and that allows you to release some of your super for a deposit. And now, you know, Labour is talking about the $3 million extra tax and all these other things. So it feels like super is going to be a different entity by the time I retire. But not much you can do about it. Just be aware that it can happen.
You know, we look into that. It's all sort of the Peter Costello's sort of the future fund, and how privileged, I suppose we were at a point of time that we effectively paid off all the government debts, and you know, John Howard and Peter Costello, what do we do with all the surplus cash? They created that future fund, right? So that's all good, right? Now the future fund is not doing the best. No. in the sense that we had to dip into that future fund number of times. COVID was one example, right? That we had to dip into that future fund, which one understands practicality. Also, on the other side is that if we look into the Australian population, no different to any other Western country, right? We are aging population. And we're living much longer, right? And we sort of speak much more is that whether we sort of go earlier sort of a retirement as such, right? So you add away all of those combination of that sort of that whole elderly generation, which is sort of building quite a bit more. So if you look into Japan, is that Australia is that's our pathway. That is where we're moving. Means that super will become more and more and more being tested. Why? Because the government pension will be more and more and more being tested. How much government can pay to everyone as a retirement, right? And this is where the government will go back on the super and try to sort of rely on the super and say whether we can have double dip. One is that you pay your own retirement. Second is that I want to get a little bit of tax out of it as well. As the government.
I mean, I think it's inevitable as governments are running deficits around the world.
You
know, it's different from a household. You don't have to balance your budget immediately, but over the long term, you still have to have some degree of balance.
100%. And there's so much impact to it, right? I mean, the bond market impact and the dollar
just
value
look at
impact
the
US.
You know, what's happening in the US. They can't even afford to pay. They're going to get to a stage where they can't even afford to pay the interest rate on their own thing.
I mean, there's two views to it, right? I mean, there is one view is that, oh, good Lord, how bad they're doing, and then they can't afford to pay that many $1 trillion, which is getting refinanced again next year, right? And I agree with that, right? Or there is sort of a contra view is that is it more of a active effort of to go in there and almost bring in that whole recession in there. And if we bring in that whole recession in there, means that everything will drop, interest rate will drop. Donald Trump is sort of keep trying to sort of sack the head of
I know. It's a balancing act, right?
Reduce the rate. He's screaming, right? Because of that interest that he has to pay.
And but the problem is that the more uncertainty he puts into the market, the higher the rates he has to pay because it's not AAA anymore. They used to be.
You know, I'm been investing so many years, right? All the way back from 1999 that I've been investing, and I sort of look back and I say that, I only recall few handful of time when we had so many uncertainties in the open world, right? And in terms of finance, right? I mean, COVID was beyond our control, let's say that. There was that Asian sort of the crisis at a point of time. Okay, there was this, .com sort of the crisis at a point of time. Some of those things within beyond to us, right? And I think this whole tariff and Donald Trump sort of creating quite a bit of an havoc, it's really up there in terms of the uncertainty.
It's very... it's created by one person. I think that's the ludicrousy component of it. Anyway, we detracted a little bit.
Yes.
So what are the other things we should be doing before the end of financial year?
Substantiation and to ensure that all of your documentation being kept in the right way. ATO has got absolute full rights in terms of auditing to anyone, because our is a tax is a self-assessment system, right? What you think is right is what we lodge, but ATO can review it. And the other thing which I always get quite keen is that in terms of the benchmarking and benchmarking and the data matching, and we as a individual, is that we should always ask our accountants, have we done the pre-filling report, have we checked it, and have we done the benchmarking and the data matching? What's benchmarking means is that ATO has got a whole bunch of reports saying that, all right, so if you're a doctor, this is sort of, we expect that on the basis of this is your income, that's the pro rata of the expenses that you're supposed to have. So let's say as an example, you're supposed to have 20% of, maximum 20% of your income as being deductible expense if you're a sergeant, let's say, right? Or let's say if you're an intern, that this would be the maximum of the deduction. Now, they're not concrete signs. They're more sort of an indicative signs as such. Yes, it's being relied on lots of real data, but they're sort of indicative. So where the benchmarking comes in is that if you go around and if you sort of have all this deduction that you've sort of been claiming, where you are much higher than what's the ATO statistics says, then it's all likelihood there would be an audit. Now, audit doesn't mean one is doing anything wrong, because if you genuinely incurred all of those expenses, then those are genuine expenses. But this is why this substantiation comes in, quite important. This is about being aware of it, comes in quite a bit. Because, ATO's whole audit system is anywhere between 3 to 5 years late. Means that if I do a 30th of June 2025 returns in the next couple of months or so, it doesn't mean that there would be an automatic audit. Audit can take 4 years or 5 years. So all you would receive.
And why is that? Like, why? I mean, if they're automating all these processes, why do they do that? I mean,
good question.
And how long do you have to keep all the receipts in your shoebox?
Good question. Why are they doing it? I think nothing other than inefficiency, right? And nothing other than that the system hasn't been generated as yet in terms of making it automated. Challenge is that, let's say, you're doing something and you got 5 years later, someone is asking you, give us this receipt and give us this receipt, right? It's just that the memory is not fresh. So that's why what we say is that we sort of say is that whenever you do a return with an assumption that everything is subject to audit. Everything will be reviewed. And you almost do that with that sort of the audit proof, that if I'm not going to pass this audit, I would not be doing this return this way. So why are they doing it? It's mainly because that sort of the automation hasn't kicked in as yet.
Yeah, you would think that with all the resources they have, that should have been a lot. If the data matching,
they're still very light, right? They're like 4 to 5 years. And what's the other pointism behind it is that it's not only 4 to 5 years. Is that when you get the audit, you generally get 14 days. Right, you get 14 days you got to do. Now, normal substantiation easy to prove. That's fine. Where sometimes people get caught away, that I've seen from experience, is that this concept called 6 years rule of a CGT exemption. Means that you're living in this property as your principal place of residence, and you're living in there for a number of years. There's no CGT. You upgraded that, moved into a different property. You decided to rent that original property. You can rent it up to 6 years without paying the CGT. But that means you would pay CGT on the second property. That's fine if you sell it at a point of time when you sell it. If you never sell it, you're not paying it, but you get that exemption on the first property under the 6 years rule. Where it comes in is that you got to keep all the substantiation. Is to prove that at this particular point of time, I left that property. Here is a proof that I've rented, i.e. having that lease documents. Here is a proof that all my utility bills and everything else at this point of time was coming back to my own home. This is my new home. So lots of tickling substantiation that it needs to be. And that substantiation is the responsibility of the individual taxpayers. You don't have that substantiation, capital gain tax.
Yeah. Well, I mean, hopefully you've connected some electricity bills and that comes through in the electronic form, and you haven't deleted all of them.
Exactly. And that's where it is that collect the documentation and the substantiation, keep them as if there would be some review. If there's no review, all good. Generally speaking, there isn't. But it's like that insurance policy is that you sort of do that policy saying that, well, 1 in 1,000 chance, but I can't afford to take that 1 in 1,000 chance.
Any other thing, because as we get to the end of the financial year, we've now prepaid some of our insurances, we prepaid some of our interest, we've even contributed extra to our super just to get up to the concessional cap. What other activities should someone be doing, towards the end of financial year? And perhaps for the new financial year, if you haven't been doing things the right way, is now the time to set up so that you start off in a new financial year fresh? Is that something you would do or recommend?
Right. Yes and no, in the sense based on the circumstances, right? Individual tax return B sort of gets a little bit simple. Is how much that you can claim is how much you spend and whether it's being associated with the substantiation.
For say a lot of us are sole traders and we should get our books in order, get accounting software and all of that sort of thing.
Exactly. Then we go to that next layer, right? And we sort of say, all right, not only individual, let's go to the business clients, right? Let's go to that sort of a sole trader. Let's go to that sort of the service trust, right? Let's go in terms of your shareholding trust. Let's go in terms of your investment trust. Lots of planning mechanism in there that one needs to do. What are the planning mechanism? Is to make sure that there is a timing mechanism and there is a permanent mechanism. Timing mechanism means that we sort of do a planning which is really just timing benefit, but nonetheless gives us benefit. The permanent mechanism is that we do things which has got a permanent additional benefit. The example of timing differences is that if there is a way that we can bring forward some of those expenses.
Yes.
So let's say as an example, right, is that this is 29th of June and I know I'm going to get an invoice on 1st of July. But if the invoice is actually being raised on 29th of June back to myself, me being liable to it, under the accrual system, I would be able to claim that, right? But 1st of July means that it becomes next year. It is a timing difference because eventually I will still claiming it, but claiming it 1 year earlier is better.
Yes.
Similarly with the income side of it, right, is that any income which is not being received on this side of the financial year, it gets rolled over on the other side of the financial year, means that we don't need to pay tax on that income on this year. That's sort of timing. Then is sort of a bit of a semi-timing of a concept called closing a stock as an example, right? Closing a stock in the sense that sometimes it could be, let's say doctors as an example, they're doing this, they're buying this, they're selling this and few things, right? Closing a stock, you've got a valuation mechanism through which you can bring in a revenue or income in a certain way, all within the tax law. Timing difference, but one can consider depreciation as an example, right? That there is a timing, but there is a planning mechanism in the sense that, well, do we buy it before 30th of June? Do we buy it after 30th of June? Before 30th of June is good, means that I can claim this side, right? Before 30th of June, how do I claim it? Is it on a pro rata basis or is it more in terms of some accelerated basis, right? Can it be written off as a one-off? Before 30th of June, based on what the value is, arguably still can be. Can I justify that my useful life is less than 3 years of this one asset, i.e. I want to claim that 100%? And the answer is yes, we can do this, right? So those things that one need to take into account, the
so
timing
asset
difference.
write-off, basically.
Timing difference as well as the asset write-off, right? Then with the tax planning side of it is that one looks into it and one sort of says, what are some of the permanent differences that we can, And the permanent differences, things such as like, well, is that whether there are some fines and penalties which needs to be added, so it's not tax deductible. Superannuation, that extra layer of the superannuation that we sort of paying it, that sort of is a permanent differences. So all those deductibility, but Australian tax system is a system where if it is simple, it's actually complex.
No, it's very complicated. It's probably
more the simple the affair, more the complex from a tax in the sense that your real tax benefit comes in when you have different layers of structures. Because that's where you sort of play with the structures, all within the ATO's rule.
And I think another one, if you have unpaid dues to the ATO, the interest from the next financial year no longer
That's right.
gets deductible.
1st of July onward, it is saying that the general interest charges, they would like it not to be deductible.
Yeah.
And you can't get that remittance either from 1st of July onward. Yeah. So which is just sort of a bit scary because it's pretty close for a whole bunch of reasons. Clients at times have a little bit of interest. 1st of July onward, you can't claim this. Yeah. Can't claim it. You can't even ask for the interest to be remitted. Yeah. Structure comes in.
What does that mean? You can't ask for the interest to be remitted?
So, let's say as an example, for some reason that I haven't paid my BAS bill within a period of time, and I've got a $5,000 interest deduction. What we used to do, still do it, is that we used to go back to the client saying, pay it off. And when the client pays it off, then we can go back to A2 and say, guys, there was a special reason why it didn't get paid. And these are some of the reasons why it didn't get paid, right? But now it has got paid. As you can see, that it's being fully paid and there is no amount being outstanding. And generally speaking, from our experience at you used to reimburse that interest. They would say, all right, that's not good, but we understand you rectified the matter. You understand that you had an exceptional circumstances. That's fine. We'll give you the interest back. 1st of July onward, the rule is that there would be no remittance.
Yeah.
Doesn't matter whatever the circumstances.
No forgiveness.
No forgiveness.
Yeah.
Right. Which is a strong standing, right? But that's sort of where it is saying. Coming back to the tax planning, right? Is that structure is the next layer of the tax planning. We started with the individual saying what can we claim. Then we gone back into a little bit of a different layers of a structure. What can we claim within the structure? Third is to create and establish the right structure in terms of what the tax would be. So this is where, rather than sort of being micro of what we can claim, what we can't claim, what you do is that you take a zoom out approach where it is a macro. And macro means now you are overseeing it, saying that I want to establish my structure in a way so that my natural deductions flow through. And what does that mean, establish in a way where my natural deduction flow through? Family trust, as an example, is arguably a good structure for investment holding. Why? Because your bottom line profit is distributed in the right way. So if you were to buy that asset on an individual name, all the income needs to be paid by the individual name, no tax flexibility. Family trust, you can put it on that individual, you can put it on his wife's name, the kids over the age of 18, quite a bit more flexibility as such.
So is the best time to start all these things at the end of the financial year or just in the new financial year?
Good question. A final comment I was going to raise about the tax planning, perhaps we touched that at the moment. No, good point. Perhaps I touch at this moment. Tax planning doesn't and must not be only an year-end exercise. Your tax planning must be a continuous exercise. On the year-end, what you do is that you sort of touch base and clear away and make the loose ends. But it can't be only time you do, because many of those deductions are time sensitive, right?
Yes.
So if you establish on 15th of June, you're only getting 15 days of tax benefit, right? So we don't do that. It's sort of really sort of spreading that over a period of time.
But for someone who is planning for the next steps, do you create your structures on this side or the other side? Because if you create it before 30th of June, technically you still have to file something for this financial year, even though it could be nothing.
Good question.
Or does it not matter?
Yeah, good point. Good question, actually, because I would suggest that probably still on this side. Why? Because you get that some of those deduction. And on the other side is that if you have to file a return, it's a nil return, right? So technically there should be almost no cost, if not zero cost. You may still have to pay the ASIC fee, but the rest of it is sort of a no cost. So what I say to very often my clients is that if you know what structure you're doing, you're definitely doing it, then you set it up when you need to. And if it's just a few days on this side or that side, definitely on before 30th of June is better as opposed to after 30th of June. But not only cost be, right? Like that structure needs to be right structure with the right reason behind it. Investment, as an example, is discretionary trust. Yeah. Sometimes you may say, well, I want to set up an investment company for 1, 2, 3, 4 reason, right? You may say, well, I'm doing a business entity for 1, 2, 3, 4 reason, right? I'm doing a joint venture, which could be a different structure. I might be doing a larger construction with 10 other partners. Then perhaps it could be a unit trust. So what is the right structure that we set up on the basis of what is my exit strategy? And that saves you the tax.
But timing, it's like... this side if possible, the other side.
Yeah.
It's not the end of the world.
No, it's a timing difference, right?
Yeah.
I mean, you'd prefer on this side of the equation, so you get a bit more deduction on this side, but it doesn't need to be. It could be on the other side.
Yeah, absolutely. And I think this is probably, I'm using this podcast to sort of stimulate people to say, if you got a good accountant, go to your accountant. If you haven't got a good accountant, find a good accountant. And to see where your needs are, at least.
Yeah, I agree. I suppose, what's the definition of a good accountant, right?
Well,
that
how long's a piece of string? It's a good accountant for you. And
and you know, I mean, there's no one definition, of course not. But I think some of the attributes that I would like to have personally is that, number one, who is experienced. Number two, who's sort of actually physically done this, right? It's not a theoretical experience, it's practically, ideally. Number three is that someone who's very, very, very proactive. Proactiveness is important. Number four, someone ideally who's got a sense of pragmatism, in the sense that it's sort of almost your risk profile. What level of risk profile you as an individual are comfortable, what level of risk profile that your accountant is comfortable, right? You don't need your accountant to be extremely bullish. But on the other side of the equation is that you probably still want your accounting to be inquisitive enough so that they can go around and actively find a solution for yourself, right? And probably one last comment that I would say is that it comes back to all about the communication.
Yeah.
So communication. How often do you sit down with your accountant? Ideally, business entity should be at least 4 times. Even individual,
4 times a year?
4 times a year. Even individual should be, in my view, anywhere between 1 to 2 times. And what do you do on those meetings when you sit down? You strategize. You say, what am I? Where I wish to be? What is the gap? And what do I do to fulfill some of those gaps? That proactiveness from an accountant to establish some of this is fundamental.
Yeah, beautiful. And I guess, whatever you're preaching, you're also doing.
We desperately try to do that, right? I mean, at the same time, what we say to ourselves is that we always sort of stay humble, stay grounded, saying that it's the intention, it's to be right, but then you must follow that through with the action, right? And this action is that it's not just so much you leave that as a theory saying that let's do all of those. And sometimes it gets hard, right? Because your client base increases, people have a whole bunch of reason, and you sort of say, well, I send you an email, I really didn't receive a response from you, so I've sort of done my side of the equation, but you haven't responded, right? So that's okay, I went back to the next person. We don't do it this way. We actually pick it up, everything into our responsibility. I send you an email, you haven't responded, I think it's important, I will call you. I will find a way to speak to you saying that, B, I understand you're very busy. We probably still need to sit down with the tax planning side of it within that period of time. And I think that proactiveness, and I think that sort of care factor, and I think that's sort of a longer term sustaining view, because through the care, you're going to keep them for longer term. I think, to me, those are some of the attributes of good accountant.
Excellent. Now, before we finish, any sort of final sort of words for your listener before the end of financial year, or,
Make sure you do have end of financial year tax planning with your accountant. You'd be surprised to see how many people still don't actually have it. Have a financial planning meeting. Don't do it too late towards June, end of June. Do it early June, ideally. So you've got enough time to sort of implement everything. Get your accountant to look through everything, all of your sole trader, business entity, investment entity, super fund, individual. So accountant makes a holistic decision in terms of everything else, right? Get a bit of an indication saying, well, we only got 1 month to do some of those planning side of it, and we want to do it now, but we also want to look through next year. Make sure that your risk parameter is being created in the right way. Nothing too fancy, nothing too assertive is what we try to do, because it doesn't work. It's not right over a period of time. It's always that steady as we go is what we do. And the fundamental thing that I always sort of say is that, one cannot be an expert on every single field. But in an ideal world, if you know enough, so you can challenge your accountant. Hang on, you've given me those 3 or 5 things, which is great. But I was reading this, and we haven't really discussed this. Is it applicable in my case? I'll give you an example, right? Is that I've got a doctor client is that who's got about 500 odd grand basis that he could pay in time, and cash flow wasn't there for a whole bunch of reasons. So we took a loan and utilized that loan to pay that 500 odd thousand to ATO. The interest of that loan is tax deductible.
Yes.
Right. And sort of just knowing that it's tax deductible and claiming that, and that bit of the knowledge is there, right? So you sort of need to know enough on reading in the open world. So if your accountant misses this, at least you raise that to your accountant and create a mechanism where it's not a, I suppose, click a box and move on mechanism. It's a hands-on. So in our office, as an example, we've got this concept called 3 pairs of eyes. Means that, let's say if someone work sort of comes in, a entry level, graduate level, intermediary level, they will draft it. Then it gets reviewed by our manager. Then it always gets reviewed by a partner. Once it gets reviewed by a partner, we don't send it out to the client. We actively organize a meeting and we sort of say, let's go through every single number by number by number by number basis. And when we go through the numbers, we pick up a lot of things. And right at the end, we sort of say, have we got everything else? Was there anything else that you are supposed to provide that you haven't? Or have we missed anything else? And only when the client sort of says, yes, I've given you everything, you haven't missed anything, then we send away to the client to sign it. So we call this the 3 pairs of eyes. Someone drafting it, someone reviewing it, and a senior partner reviewing it before we go to the ATO. That mechanism, in my mind, is very important. So whenever you stay with an accountant, where accountant gets the amount of the work done, emails that to you, risk is high. How does the accountant know everything which you've incurred? How does the accountant know that you haven't missed something? And how do you know that everything which you have given have been included as such, right? So those are the words which are important, that sort of that care factor, that sort of almost working together as a team.
Yeah, beautiful. Thank you for coming in today. And
Thank you.
We'll see you on the other side.
Thank you very much. Thank you, V. Take care.
This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.